For you this week, we discussed the Dow Theory, an integral part of technical analysis. Although modern technical analysis has come a long way over the years, most investors still like to use classical methods in their analysis. Dow Theory, one of the first and oldest methods of technical analysis, forms the basis of the methods used today. For this reason, we do not recommend investing or trading until we have learned the principles of Dow Theory. So, what is the Dow Theory? The starting point of the Dow Theory is based on the examination of the convergence between the Dow Jones Industrial Index Average and the Dow Jones Transportation Index Average. This theory is a financial theory that says that the market is on an upward trend if the Dow Jones Industrial Index Average rises above an earlier significant high and the Dow Jones Transportation Index Average accompanies or follows it within a reasonable period. Dow Theory, it is a trading approach developed by Charles Dow, who developed the Dow Jones Industrial Average in 1896. The Dow believed it was a reliable measure of the stock market, able to determine the direction of major market trends and the possible direction of individual stocks. Dow Theory tries to set the best timing for trading by analyzing the entry and exit points, price trends, volume, and other features of the stock market. Dow Theory has 6 basic principles. First, there are 3 types of trends in the markets. The most effective movement is the primary trend, which can last from several months to several years. Long-term investors using the Dow Theory try to align their portfolios with the primary trend. Active traders are interested in all trends. The next type of action is a secondary trend that opposite direction the primary trend. The secondary trend can last from 10 days to 3 months and is usually pullback that occur between 1/3 and 2/3 of the value earned during the primary trend. You can think of it as a small counter-reaction to the larger action in the market. The third type of action is a short wave, which can last from a few hours to a month. Charles Dow described this wave as noise, so he thought it was insignificant. The image contains an example of the first principle. As the graph shows, the primary trend occurred over a period of about 15 months. Many times, during the primary trend, secondary trends consisting of pullback waves occurred. It is seen that many short waves are formed in the secondary waves. The second principle of Dow Theory is that there are 3 stages of primary trends. The first stage is known as the accumulation stage. Accumulation refers to the buying of many stocks by investors or traders, or the reproduce the numbers of lots. The second stage is known as public participation. This is the stage where a new upward trend begins, and the price action attracts trend traders and other investors. The third stage is known as distribution. This final phase is when insiders sell to the public after an upward trend has grown speculative. The image contains an example of the second principle. This example is the same as the chart example given for the first principle. And in accordance with the second principle criteria, it has carried out the stages of accumulation, public participation, and distribution. The third principle of the Dow Theory is that stock prices react quickly to the news. The Dow Theory works on the prolific markets hypothesis, which indicates that asset prices contain all available information. In other words, if a sudden and unexpected event occurs, the stock market indices quickly recalibrate itself to reflect the correct value. The image contains an example of the third principle. In March 2020, pandemic news negatively affected all global markets and caused markets to react very quickly. The fourth principle of the Dow Theory is that it includes the relationship between the Dow Jones Industry and transportation indices. Charles Dow saw these indices, which represent manufacturing and transportation, as the 2 most key factors in the economy. The industrial index consists of manufacturing enterprises, while the transportation index consists of railways, airlines, truck transportation, delivery, and transportation. Both indices tend to move in the same direction. But when separated, it can be a sign that the market will reverse its trend. For example, if asset prices were rising but transportation was overused, the trend would not be sustainable. The opposite is also true, transportation is profitable, but if the market is in a downtrend, there is not a clear trend. The image contains an example of the fourth principle. The example is the correlation between the Dow Jones Industrial Index and the Transportation Index between 2019 and 2022. A similar correlation is found between stock market Istanbul industry and transportation indices. The divergence between these two indices can be used as an early signal system for trend reversal. The fifth principle of Dow theory is that volume should confirm trends. Charles Dow believed that high volume was necessary to confirm primary trends. For example, in a bullish market, volume should increase as the price rises and fall during secondary pullbacks. If volume continues to rise during a pullback, it may be a sign that the trend is reversing. The image contains an example of the fifth principle. As the price rises, it is seen that the volume increases simultaneously. The sixth principle of Dow theory is that trends exist until precise signals prove otherwise. Like Newton's first law of motion, an object in motion tends to move in one direction until a force disrupts that movement. It is difficult to determine whether the rise in a bearish market is a reversal or a short-lived rally, and lower lows should be followed to determine this. The Dow theory advocates caution, insisting that a reversal is confirmed. It is accepted that the trend continues until proven otherwise. Combining the 6 principles of the Dow theory provides investors with a framework for organizing information in financial markets. Some investors use the theory to help them decide when to buy and sell stocks. For example, an investor using the Dow theory might want to adjust their portfolio accordingly after observing a compatibility between the industrial and transportation indices. Because there is a correlation between both indices. If it has bought a stock in the industrial index, it can also buy a stock in the transportation index. Conversely, if it has sold a stock in the industrial index, it may also sell a stock in the transportation index. The Dow theory should not technically be considered a strategy for investment, but a combination of subjective rules. For example, while an investor interprets a market action as a primary trend, here another investor can only see a secondary trend. In addition, the Dow theory may be late in defining reversals. Just some investors may notice that sell signals are coming after a reversal has begun. Another feature of Dow theory is the idea of line ranges, also called range trading, in other areas of technical analysis. Line ranges are when traders expect prices entering a period of consolidation to move between the support and resistance line. For example, if the price reversal from the support line, it buys, or sells if it's reversal from the resistance line. One of the main techniques used to predict trend turns in Dow theory is peak and bottom analysis. A peak is defined as the highest level of price action, while a dip is seen as the lowest level of a price actions. Keep in mind that the Dow theory assumes that the market is not moving in a straight line, but that the overall movement of the market is trending in a direction, moving from bottoms to peaks and from peaks to bottoms. The uptrend in the Dow theory consists of consecutive higher high and higher low, while downtrend consists of lower high and lower low. This is the end of our video. Thank you for listening to us. Lots of profits.